Hi, and thank you for watching. My name is Mike Mills, and I'm the managing partner and co-founder of the Legacy Advisor Group. Today is Thursday, July 30th. This month in our Market Minute, this recording is going to be a little bit early, as the next few weeks we'll be busy with family transitions. We actually send our oldest son to college in less than 2 weeks, and as any of you that have done this know, it's a bittersweet time. We're excited for the opportunities that lie ahead for him, and know that this is the natural progression of our children growing up and moving out. But we pause to reflect on the shift of him leaving our home for his next step in life. This month, we'll keep this video rather short because we're still in summer, and we'll give a quick update on the markets that we've seen over this last month and a general thought or two. All of the information that we provide today is through July 29, 2026. The month of July so far has had no shortage of geopolitical news and volatility. Yesterday, we had the July Fed meeting, and Fed Chair Wash left rates unchanged. The market, however, did not act favorably to this. There were actually 3 Fed governors who dissented from this decision, wanting the Fed to increase rates, making the next Fed meeting more uncertain and leaning towards a rate increase. However, Chair Wash has said he is not in favor of giving forward guidance, and the market that has grown so used to this reacted negatively. July in general, though, has been a volatile and increasingly selective month for investors. The S&P 500 is so far down about 2.4% for the month, while the NASDAQ composite has so far declined roughly 6% as investors became more cautious about elevated technology valuations and questioned how quickly massive investments in artificial intelligence would translate into profits. Energy was our clear sector leader, gaining approximately 11.3%, helped by elevated oil prices and tensions in the Middle East. At the other end of the spectrum, consumer discretionary fell about 4.9%, with technology close behind at roughly a negative 3.9%. Healthcare, financials, and real estate held up comparatively well. Ongoing concerns about semiconductor competition in China and AI-related spending continued to weigh on technology shares, letting some air out of the tire for chip stocks. A Wall Street Journal article from July 20th expressed how U.S. AI companies are concerned about the competition from China and looking to Washington for help. Developed international markets provided a little bit more stability. The MSCI IFA index gained approximately 0.8% for the month through July 29th, demonstrating the potential benefit of international diversification we've talked about before during the pullback in U.S. technology stocks. The economic story in July has been one of steady growth paired with stubborn inflation. The U.S. economy grew at an annualized rate of 2.1% during the first quarter, supported primarily by strong business investment in technology equipment and software, though consumer spending grew at its slowest pace since 2022. Inflation remains the Federal Reserve's main concern. Headline PCE inflation was 4.1% year over year through May, while core PCE inflation was at 3.4%, both well above the Fed's target of 2%. As a result, the Fed has kept its benchmark interest rate at 3.5 to 3.75, reinforcing expectations that rates may remain higher for longer. The 10-year Treasury yield climbed from about 4.42 at the end of June to 4.67 yesterday on the 29th of July. That's an increase of 25 basis points over the month, and that's created additional headwinds for growth stocks. Overall, the labor market remains relatively stable and business investment continues to support the expansion, but softer consumer spending, elevated energy costs, geopolitical tensions, and trade uncertainty are keeping investors cautious. There was an interesting chart I saw recently that showed the market going up while sentiment continues to go down. An interesting chart, but nonetheless not completely unusual as many investors react negatively to headline news. Regarding that 2.1% growth in the first quarter, our friends at First Trust wrote that data centers are where the action is and continue to grow rapidly, with the nominal value of construction of these structures up 23% from a year ago. Likewise, shipments of computers and related products plus communications equipment are also up 23% from a year ago. Put all this together, and approximately 50% of our GDP growth is coming from AI and data center spend. Regarding volatility in the month, it's always important to remember that volatility can be our friend, as well as diversification. We've had no shortage of that over the last month, and yet we remain very focused on the long term. Now, I'm sure you've gotten tired of hearing a lot about AI, but I can remember back early in my career. Matter of fact, when I was still in college studying investing, economics, and individual companies, this was during the internet boom that led to the dot-com bubble. And all you heard about was what the internet will do and how to make our lives better, etc. The talk of AI is not too indifferent from that time. I think we all must get used to continuing to hear more about AI. One of the very interesting things that we've seen recently here is the increase in volume of talks about inflation and disinflation and its association with AI. Our opinion is that we are in a for inflation really staying higher for longer. And I think we've talked about that a little bit before in these videos. You see, we got so used to sub 2% inflation for well over a decade. Now we must get used to inflation north of 3%. However, AI, once fully invested in and fully working, could create disinflation, which is a slowdown in inflation, something I believe we all will welcome. Regardless of volatility and market news, we remain focused on good long-term investing. Will every investment always do the best in the short term? Absolutely not. But if it did, then we'd say we're not properly diversified. One more thing I'll touch on is we are in a fully 24-hour news cycle, constant social media feed, and quite frankly, an overload of information. I'm in favor of getting to the point and less is more. Now, the first can be a fault of mine, but the second has helped with the overload of information we have these days. Don't get me wrong. I love to read, but there's an overload of information. I add this to say that there's been so much news about new Fed Chair Warsh and his rate decisions, as well as whether public companies should provide earnings quarterly or semi-annually. Personally, I wish the Fed would not communicate so much and earnings calls would be only once or twice a year. As a Marine, I'll add I wish we didn't have constant coverage of what our military is doing or about to do. Less is more. I'm old enough to remember a time when Alan Greenspan would come to the Fed meeting with his briefcase and speculators would try to associate whether rates were moving up or down based on the thickness of his briefcase. In honor and memory of Greenspan, he debunked this myth in his memoirs, attributing it to whether or not his wife had packed him lunch or not that day. Greenspan was, by the way, notoriously vague in his Fed speak. The point is, we're as a people infatuated with more information. But what do we do with that information? Typically nothing, or in many cases, the wrong thing. When it comes to investing for the long term, less is more. Is it a good investment? Has anything changed fundamentally? And have my personal goals changed? These are the main questions we should ask. As a reminder, we talk about markets and investing in this video. However, without a plan, it's hard to say whether you're invested properly. This is why we spend so much time on getting to know you, working on your planning, and collaborating with the state and tax professionals. We welcome the opportunity to talk with you, your friends and family, more about planning and tax strategies. And on behalf of our team, thank you for your time today, your friendship, and your trust, and we hope you have a great rest of your summer.